Hey, everybody. Happy Monday to all. Happy Monday. I just thought I'd do kind of an impromptu intro for the podcast today. Sometimes it's just good to go do a quick live, do the intro portion of the show, and then you can see the entire thing on YouTube or listening to the podcast. Either way, either one is fine. First off, I wanted to say a big thank you to everybody for all of the birthday wishes. Unfortunately, it was definitely not my best birthday ever. My dog's birthday is right after mine. Hers is actually today. And she has been sick. And last night, spent about 2 hours in the emergency room. She was throwing up and having digestive problems and all this stuff. And I don't know. Seems to be a little better today, but didn't get much sleep last night, unfortunately. I had to wake up just about every hour. There were a couple sort of 2 or 3 hour spans there, but at first it was waking up about every hour to let her out. She was just having a really rough night. So hopefully tonight will be better. But thank you for all of the birthday wishes for me and for Coco. And there's Coco, by the way. If you're watching the video, there she is on the Today Show. I was looking for some pictures of her just to share with you. And there she is with Al Roker on the Today Show. And by the way, if you're listening to this only later on audio only, you can find this on our YouTube channel as well. And there she is as a little puppy. No, she did not actually drink that Guinness beer. If I had her drinking beer at what is that, about 10 weeks old, got her at the animal shelter as a puppy, believe it or not. So occasionally you can get a little puppy at the animal shelter. She'd probably have a much stronger digestive system and probably wouldn't have been sick, but might have had an early demise. And there she is on the plane on one of our flights. So what a great pooch. And I know all of you who have pets and you love your animals and you just want to take care of them. And veterinary medicine is really uh, that's got to be a tough slog in a way, because you the animal cannot tell you how they're feeling. You get no feedback. It's a zero feedback loop, right? You have to guess at how they're feeling. Yes, they look at you with their very expressive faces, and you look at their actions and so forth, but you just don't really know. Whereas with a human patient, they can give you feedback, and that feedback is so valuable. So thanks for all of your well wishes for Coco, and for all happy birthday wishes for both of us. Hey, something interesting. A lot of folks have talked over the years about how real estate underperforms the S&P, the Standard and Poor's, the S&P 500 index, which is really the most widely used gauge of uh, really what the economy is doing. Or, well, the stock market and the economy are definitely not the same thing. I think we've all come to realize that. So I won't say it's a gauge of the economy, but it is certainly a gauge of the widespread stock market. And since about 69 to 70% of the S&P 500 is consumer spending, and that is really its ratio of our entire economy. It is pretty significant. I thought this was interesting. This is a Business Insider video, and it shows you Warren Buffett's home, his very modest home, for someone who has been the richest person in the world several different times over the years. And if not the richest, are right up there at the top of the heap. So he's obviously a Wall Street insider in a lot of ways. I think Warren Buffett is a huge hypocrite. Hypocrite. Yep, he is. But anyway, listen, I like his value investing philosophy nonetheless. And, there's some, like every person, there's good and bad, right? You got to take the good with the bad. But I am impressed that Warren Buffett lives in such a modest home, being such a rich guy. He has only one extravagance, he says, and that is his private jet. Otherwise, he drinks diet cherry Coke and eats cheeseburgers. He's a pretty homespun guy, obviously. So here's his modest $652,000 house. And I just thought I'd show you this video because there is a good lesson here. So let's take a look at this. Okay, let's take a look at this. Oh, yeah, yeah. We got to watch an ad first. So here's the ad, and then we'll get to it. But it's a pretty good lesson because it really shows you the difference between inflation, house prices, and the stock market. Here we go. So here's his modest home. Okay. Omaha, Nebraska. He's called the Oracle of Omaha, as you know. And just looking around the neighborhood, he's got some security, right? Rightfully so. So he bought this house for $31,500 in 1958. 31,500, 1958. Obviously, it's on kind of a busy street. It's about 250,000 in today's dollars, right? But it's now worth $652,000. Okay. So therein lies the lesson, right? A lot of people say, well, the S&P 500 and that has determined to some extent Warren Buffett's success, right? As a basically a fund manager in Berkshire Hathaway, essentially. I mean, you can slice and dice that however you want, but then you adjust for the official rate of inflation, which we all know is understated. Why is it understated? Because it's understated because there are three basic manipulations: weighting, substitution, and hedonic indexing, right? There you have it, right? It's worth $652,000 today, but the $1958 adjusted for inflation are only $250,000 today. So the house increased faster than the rate of inflation, at least by inflation's official measure. Now, it depends who you talk to, but most experts will say that generally real estate nationwide, of course, you've got linear, cyclical, and hybrid markets. The US is a big, giant country. There's no such thing as a national real estate market. There are about 400 MSAs or metropolitan statistical areas, about 3,200 almost counties in the United States, and many more cities than that, and many more zip codes than that, and many more neighborhoods than any of those. So it's a big, giant country, very diverse, lots of different types of real estate markets. But if you ask the experts, they will say that nationally, real estate increases or appreciates at about 6%, maybe 6.7% annually, right? You do this over the course of decades. And of course, it depends exactly what decades you measure. It depends what product types you measure. Are you measuring the luxury market, the entry level market? Are you measuring single family homes? Or are you including condos and townhomes? Or are you including them all, or just the condos and townhomes? You can slice and dice this a million ways. That's why there's so much disagreement. There's so much disagreement because of that. But if you take the official inflation rate, and if you look at the price of the house today, you can see that it has outperformed inflation, right? Yes, you can. You can definitely see that. So I don't have the official inflation rate handy from 1958 till today, but definitely this house has appreciated at almost triple the official rate of inflation. So when you hear people say, well, real estate is a good hedge against inflation, this is what they mean. But this is nothing to get incredibly excited about. Why? Because, of course, most people leverage their real estate. So when they use leverage, remember Archimedes, the famous mathematician philosopher from antiquity, Archimedes quote, he said, "Give me a lever long enough and a fulcrum on which to place it, and I will move the entire world." right? Because leverage allows you to do a lot more than you are capable of with your own strength. So, real estate is the most debt friendly asset class in the United States. It's the most tax favored asset class in the United States, especially income producing real estate. And it's also the most historically proven asset class in the entire world. So you would leverage your real estate. Okay, let's say you put 10% down. And let's say real estate, and you notice I'm sort of specifically not talking about income property because I don't like to call it real estate because it's really so much more than real estate. It's income property. Well, say that your real estate, just real estate like Warren Buffett's home, obviously not producing income for him. He lives there, right? The many times richest man in the world, many different years, lives in this modest home. And so say it outperforms inflation by 3% annually. Now, the property is outperforming inflation, and so you're making maybe double the rate of inflation. That's great. It's a good hedge, uh, but it's nothing to write home about. Now, some say it just keeps pace with inflation. And, inflation goes up, it diminishes the value of our currency, our dollars, and real estate prices go up. So they keep pace with inflation. So you're not falling behind. That's good. But if you leverage the real estate and you do it on a 90-10 LTV or loan to value ratio, meaning 10% down, 90% bank financing, then you get to multiply that return. So now you take that 3% annually and you multiply it, and it becomes 30% annually without anything else happening. Okay. Just the 3 to the 30 without having some terrific appreciation rate, without having uh, inflation induced debt destruction, one of the hidden strategies that I teach. That's kind of my trademark term, inflation induced debt destruction. Well, not kind of, it is IIDD. I know it's a mouthful. And, listen to the podcast or check out the YouTube channel for more detail on that. And without tax benefits and without rental income. So, what if you're not paying for the mortgage? You outsource the responsibility for repayment to that mortgage to someone called a tenant. They pay it for you. Plus, they decide they're going to give you a little bonus every month and they're going to give you an extra $250 per month, right? Well, that really adds up. And that's why it is the most historically proven asset class in the entire world. By the way, Brent Conaway, thank you. You're saying your wife is a veterinarian. Yes, thank you. And a couple of vets who follow my show have reached out and, offered their advice and so forth. And I very much appreciate that. And so thank you. Thank you for that. Anyway, that's just a little lesson on Warren Buffett's house. Now, today's guest is Sean O'Toole. He's been on the show several times, but not for many years. And he's the founder of Foreclosure Radar and Property Radar. Okay. And he's got some great statistics on the real estate market and what's going on in different markets around the country. And, are we going to have a foreclosure crisis? And a lot of the doom and gloomers, I think, will be pretty impressed with what he says, because he says, no, you are wrong. Yep. You're wrong, doom and gloomers. I know you want to be right. Doom and gloomers, misery loves company. It's just kind of human nature. We all love to, predict the end of the world. And, I don't think it's going to be any big deal this time. I really don't. The economy is improving. We'll see what happens with the election. Less than 30 days away. We've got a pretty crazy election coming up. We know that we're likely to have civil unrest. I think real estate's going to be really hard hit in some of these cyclical, expensive urban markets. Here's one to talk about. How about San Francisco? San Francisco, here we come. Or is that just California, here we come? I don't know. Whatever. Uh, Nobody knows the reference anyway. That's a very old little song. But Patrick, one of our team members, posted this in our content group. And it's a great chart from Apartment List. They've been on my show a few times and they've got some good data. And it says September ends with another fleet of moving trucks heading out of San Francisco as rent growth declines 20% over last year. Okay. So things are pretty bleak here. And just look at this and compare San Francisco to the entire Socialist Republic of California to the entire United States. And we're seeing negative growth on all these numbers. Now, why largely are we seeing that overall? It's a minor thing when you look at the US stat, but why? Because everybody's buying. Now, one of the things I've taught over the years many times is an idea I call the 3 dimensions of real estate. And there are obviously more than 3 dimensions, but hey, it sounds good, 3-dimensional. We all get the idea. It's not flat, 3 dimensions. And in the 3 dimensions of real estate, I talk about the counter cyclicality. It's a mouthful. Hey, folks, I didn't get much sleep last night, so give me a break. I probably am showing it, and I'm another year older, so I'm showing that too. But I swear when I woke up on my birthday, I had more gray hair than before. I swear. It's weird. The gray hair, it kind of ebbs and flows. I don't know why. Can hair turn from gray back to its normal black color? It kind of seems like it does. Sometimes it seems like there's more, but I kind of like it, honestly. I think the gray actually looks pretty good. So I'm okay with that. Just keeping it in the head would be a good idea. Yeah, not letting it fall out. Okay, so back to business here. So we see this, and when everybody is rushing into the buyer pool, when they want to own properties, when the home buying market is really strong, when interest rates are really low, a lot of people move from the renter pool to the owner pool. So that actually hurts rents. Now, when the market is soft and it's more of a buyer's market, and that's usually the result of higher interest rates, lower home affordability, then we see upward pressure on rents. So isn't that great? Because as a good real estate investor, all you need to do is adjust your strategy as time goes on. So when you're in a seller's market, like we are now, you benefit from appreciation. Hey, that's great. And when we're in a buyer's market, you're not benefiting from appreciation so much, but you're benefiting from increasing rents. Cash flow goes up and rents improve, right? So you always have a strategy because it's a multi-dimensional asset class, and you play the given strategy at that time over the years that you own your portfolio. But look, foreclosures and declining rents and declining prices and civil unrest, all true of high density, urban, expensive markets. San Francisco, Seattle, LA, gosh, maybe I need another cup of coffee. Sorry, folks. I'm a little not with it today, not much sleep. And New York. Oh, that's one. Jason, gee, New York. Could have thought of New York. It's only the biggest city in America. But all these high density urban markets with civil unrest are really not looking good. And I know there's been some debate on this. I've seen a few articles recently, and they're just wrong. They're like these apologists for these overpriced urban markets that are left controlled. They've been chasing business out. They've been chasing people out, forever. And they've just committed urban suicide. Frankly, it's terrible. The government in these cities, it's kind of all the same left-leaning government. It's an absolute disaster. So yes, I do think there will be a foreclosure crisis in these markets, but in these good, solid, linear markets, I just don't think it's going to be any big deal. And listen, don't take it from me. The data guy is coming up. Sean O'Toole is on in a few minutes. Another thing I want to talk to you about before we get to our guest and that is the commercial space program. This is an amazing time to be alive, folks. And with all the bad stuff that's going on in the world, there's a lot of amazing stuff too. Look at this. Let's take a look at SpaceX. Now, when I was a kid, I was a space cadet. The one thing I really followed was the space program. I followed every Mars landing. I remember I'd study back and, follow and study, Apollo and all the old space programs like Gemini and, the original stuff and the Russians. And it was fascinating to me. I just loved that stuff as a kid, and I used to watch Star Trek and, of course, there, Star Wars and so forth as well. But look at the cost per seat. Like, think of this as an airline ticket to space, right? And the cost per seat. And Richard Branson with Virgin Galactic is selling tickets for $250,000. I've thought about buying one, frankly, but it doesn't seem very worth. I mean, I'd pay 250 grand to do a few orbits in space and all that kind of stuff. But all this one does is it just goes up and comes down, and I've already experienced zero G in my cousin's Cessna years ago as a little kid. So I know what zero G's like. It was really cool. Now, I was scared to death. I thought he was going to rip the wings off the plane. And all you have to do to experience zero G, I've also been skydiving, is just fall as fast as gravity will pull you. That's called terminal velocity. And when you're in terminal velocity, that's zero gravity. Okay. Now, you don't feel it when you're skydiving very much because the wind and such. But inside the Cessna 172 on the way to Catalina, when I was a kid, I was wearing a baseball hat. My cousin put it on my lap and he says, "Want to try zero G?" And he goes, zoom. And sure enough, as I was freaking out, thought I was going to die, the hat started floating right in front of me as all of the stuff in the back seat of the Cessna 172 started floating as well. And then he pulled out of the dive and it all went. So pretty cool. Anyway, but when you really get to do some cool space stuff, it'll be worth 250 grand and it'll probably get a lot cheaper. Right now, it's only $55 million. Yes. So if you go on Dragon 2 private SpaceX, we just sent them up there, and it's $55 million a seat. Well, hey, it's a lot cheaper than $390 million. Now, it says here, and this is important, it says estimates for historical spacecraft adjusted for inflation. Yay, good. At least they adjusted for inflation, because obviously Apollo 1961 to 1972, those dollars aren't worth as much as they are nowadays. So we need to adjust for inflation always. Now, that's based, of course, on the official rate of inflation, which is understated. Why? Because of weighting, hedonics, and substitution. More on my podcast if you don't know what I mean by that. Okay, so Brent posted, and he says he lives on the Space Coast here in Melbourne Beach. Hey, that's in Florida. It's not too far from me. And, it's way cool to watch the rockets launch here weekly. And folks, I'll tell you something. 2 of our markets really, really directly benefit from the commercialization of space. So reach out to us at jasonhartman.com or at 1-800-HARTMAN if you're listening in the U.S. That's a U.S. phone number, 1-800-HARTMAN. And we can help you invest in those markets that really benefit from the commercial space program. And by the way, Robert says that San Francisco deserves to bleed, get a taste of their own medicine. Get a taste of your own medicine. Well, hey, listen, that's not a very nice sentiment, but it's hard to disagree, because the politicians there have just screwed it up so badly. They really, really have messed it up. By the way, do you like my dorky sound effects, or should I just, maybe I'm overdoing it? Okay. Maybe I'm overdoing it. But look at this. Look at the amount of investment going into the commercial space program. It's truly astronomical. Pardon the pun. That's pretty funny. Yeah. It's astronomical. Okay. Total value of investments in space ventures over 5-year period since 2000 in billions of US dollars. So now we're up almost $17 billion. And just look at the graph. It's not the amount, it's the exponential growth in these investments that is truly amazing. So again, there is a bit of a real estate play there. So check it out, reach out to us, and we will help you benefit from this. Oh yeah, John Legend is going to leave the country if Trump gets reelected. Can I buy your plane ticket? Please do leave. All these stupid celebrities. Remember last time when they say, well, if George Bush gets reelected, they're going to leave the country. None of them left. And then they said, if Trump gets elected, now Madonna actually really did move to Portugal. Thank God. So glad to see her go. Oh, and there's an interesting Morgan Freeman thing. I'll show that to you next time. I got a bunch of stuff to cover here that we don't have time for today because we've got to get to our guest. But anyway, also, we've got our pandemic investing online conference coming up. This is going to be great. A lot of good information. Go to pandemicinvesting.com, get a free mini book there, and join us for our upcoming conference. Now, we are going to hear from Sean O'Toole, founder of Foreclosure Radar and Property Radar. And this is going to be in two parts, today and tomorrow. So here is part one. And if you are watching on the live stream right now, check out the podcast, today's episode, for the second half, where you can hear from Sean O'Toole. And he's going to talk about this looming foreclosure crisis that so many, well, not so many, I don't know, maybe half of you think are coming. I don't know. I think you're going to be a little disappointed, but let's hear his data. So we will go to that and check out the podcast and the YouTube for the full Sean O'Toole interview. Thanks for joining me for this quickie intro today.